Welcome to Global Money Talk. Today, we are delighted to have Danielle DiMartino Booth as our guest. Danielle was a Wall Street analyst and for 10 years a key advisor to Dallas Fed President Richard Fisher, and now founder and CEO of QI Research, which does extraordinary work in following what drives the U.S. economy and the markets. Danielle, thanks so much for coming on to the show.
Happy to be here today. Thank you for having me.
Oh, well, we just saw this morning that consumer confidence had taken a little bit of a dip. Do you have a quick word on that before we get into the rest of the show?
Well, so much of the talk today has been about the difference between survey data and the hard data that we're seeing. And now we have yet more survey data in hand from the Conference Board, probably the second most closely watched of the two after the University of Michigan, which goes back to 1968. But in any event, expectations declined to a 12-year low this morning, and consumers, their expectations for their income growth is absolutely collapsed, and so there's a lot of there's a lot of concern that that we're going to be seeing a big dip in consumption, which is the key driver of the U.S. economy.
Now, I want to actually go back I can't believe it's almost a week now, but I thought Jay Powell actually did an amazing job with his press conference last Wednesday. He actually got gold to rally, stocks to rally, and bonds to rally. And literally, I was watching him. He couldn't run out of the press conference fast enough, saying,
Yep.
There's nothing better I can do. So what do you make of, the Fed's summary of economic projections and Powell last week?
Well, he certainly projected a lot of confidence in the future. The only thing I would say is that's his job. And so he has to maintain confidence. But again, by the time the Federal Reserve meets once again, which is May the 7th, by the time he's at the podium again, we're going to have two non-farm payroll reports in hand. The April non-farm payroll data hit on May the 2nd. And that is before the May the 7th meeting, so very early in the month for that payrolls data to hit. But I think he's going to be changing his tune sooner rather than later.
I was looking at one of your interviews recently, and you said this sounds like it could be a replay of July 2024, where you said that they didn't cut, and then the data that came in the next couple of months were pretty bad, and so you got a big cut in September. So you're seeing a big cut. Potentially in the Fed funds rates coming maybe May, perhaps June?
Coming as early as May. Again, what we're seeing in what we call the soft survey data is so disconnected from what we're seeing in the hard data. The Fed's projection for the unemployment rate to end 2025 is 4.4%. We were within just a hair of the unemployment rate being 4.2% as of the February data. It's difficult to foresee unless consumers are imagining their current existence. It's difficult to foresee a lot of these layoff figures, these incredible bankruptcy filings that we're seeing not manifest, not show up in these next two jobs reports, again, that forces the Fed to shift its stance, to pivot.
I'm not putting you on the spot, but would you like to give us a guess on Danielle's dots for the end of 2025, as compared to sort of the median of the Feds? Unemployment, you mentioned they only had 4.4%. What are you thinking, sort of, from all the research that you see, which is really remarkable research?
It would not surprise me to see the unemployment rate a lot closer to 5%, if not higher by the end of the year. And that's why I'm standing by my call that started out 2025 that says I think the Fed's going to cut rates 4 or 5 times total this year, 100 to 125 basis points, north of 1 full percentage point by the end of 2025.
So you're looking at perhaps a 3% Fed funds rate or thereabouts by the end of 2025.
I think that is perfectly feasible unless we see some kind of a miraculous big, huge shift in terms of where the private sector sees the employment going forward. Again, we're continuing to see Challenger Gray Christmas really did surprise the market with its February layoffs coming in at 172,000. Only 62,000 of them were the public sector cuts that have been so well advertised, Elon Musk, Department of Government Efficiency, the majority of those 172,000 job cuts are coming from the private sector. So unless the private sector itself pivots and pivots dramatically, in other words, instead of firing, they decide to start hiring aggressively, I can't see how we don't see a much lower Fed funds rate by the end of the year versus what Fed officials are expecting right now.
They marked down GDP 0.4% down to 1.7. Where do you see that? Do you think that's going to be sub 1%? Is there a possibility of a recession before the year is out?
I think that certainly could be the case. What we saw in 2001, what we saw in 2008, these were, of course, times that the U.S. economy was in recession, was that the original GDP prints came out with a plus number in front of them, but were subsequently revised to be negative figures. That would not surprise me in the least if we were to see a negative GDP print for the first quarter, and if not repeated in the second quarter. That, again, represents the momentum that we're seeing and what we're hearing from companies about their margins being squeezed, about revenues being coming under a lot of pressure. We're hearing it from home builders. We're hearing it from auto companies that are saying, even without tariffs, that the big auto manufacturers expect sales to continue declining into 2025. Again, this is what we're hearing from companies on the ground that are interacting with the U.S. consumers, who are responsible for a record 71% of GDP. Again, we could see a massive shift, but I think that we would be remiss to completely disregard what we're hearing from the companies on the ground and from U.S. households themselves.
You've done, I just want to talk a little bit about core PCE, and they marked that up to 2.8%, which made I guess the Fed at the moment a little bit afraid of cutting. And Raphael Bostic came out yesterday and said, "Well, I'm one of the guys who moved from 2 cuts to 1 cut." But in the past, you don't love core PCE, particularly owner's equivalent rent. Could you just go into that just a little bit?
Of course. Owner's equivalent rent is what economists, us dismal scientists, call an imputation. So that means it's a number that you kind of pull out of the air. It's modeled. What you're hearing from home builders, whether it's Lennar or KB Homes, is that they're pushing through the biggest incentives that they've seen in a generation in order to move home sales, discounting, in other words. And so when you see these types of announcements, you say to yourself, this is not inflationary. This is disinflationary. And again, if you're not able to push forward to pass through increased, whether it might be lumber costs or oil costs, if you're not able to push those through to the end consumer, we call that a margin squeeze, not inflation. And so that's why I try not to focus on imputed costs, but rather costs that are actually being charged to U.S. households, to consumers on the ground. We're seeing it in we saw it just today as we're recording in the Philadelphia Federal Reserve non-manufacturing survey. We saw echoes come out of the Richmond Fed survey. The prices that companies are paying in anticipation of potential tariffs, again, not actual tariffs, but in anticipation, the prices that are being paid are increasing, but the prices that are being received are not. And so when that differential opens up, again, that's a margin squeeze, not inflation.
And it is, as you say, it's a strange animal, this owner's equivalent rent. It's like I guess they ask homeowners what they think they would have to pay if they had to rent their own house or something odd like that. So, the Fed has, there are 12 Fed districts. There's the Fed in Washington. I mean, they've got to have some pretty smart people looking at this. So why are they still sticking with, core PCE? Why doesn't the BEA change owner's equivalent rent? Or is that, there's too much bureaucratic inertia and you want to have a number that the market can focus on? Surely they're getting a sense that, the inflation is not, as substantial or not as substantial as they think it is.
Well, you bring up a very good point, and I think that is why Federal Reserve Chair Jerome Powell has raised this idea of of an inflation alternative that's been around for generations. Market-based core PCE is what he's been referencing at the podium for months now, since December. And what a market-based core PCE looks at is prices that are being paid on the ground. Powell has actually gone on one step further to say owner's equivalent rent really is not what the focus should be. The focus should be on new rents, because new rents are as real time a gauge of shelter inflation as we can possibly reference. And to fill in that gap of owner's equivalent rent, the Cleveland Federal Reserve has come up with something called a new tenant rent index. That was a positive 1.6% year over year in 2024's third quarter. And it flipped to negative 2.6% year over year in 2024's fourth quarter. Positive 1.6 to negative, positive 1.6 to negative 2.6. I might be getting my numbers off by a tenth or two, but the point is we're actually seeing declining rents. We got fresh data out this morning from one of the on-the-ground apartment list companies that said one-bedroom rents in the United States had fallen again in the most recent month. These are the things that Chair Powell's actually telling you. I'm paying attention to these more realistic gauges of inflation and looking to them instead of relying on what we know to be broken metrics. So if the Fed chair himself is telling you this, then that's what our focus should be.
So would it be fair to say that the mentality of the Fed is such that they probably want to cut, but they feel like their hands are tied? And what if we cut and then, tariffs, blow through and, we get real inflation. It's not transitory. I can't believe he brought that word back again, of all things. So would you say in their hearts or in their minds, or at least in Chairman Powell's, that he does want to cut, he just can't?
I think that is the dilemma right now that's facing Fed officials. And it's because the construct of the tariff seems to change on a day by day, if not hour by hour basis.
Right.
If they were to look back at the Fed's experience in 2018 and in 2019, the Trump trade war 1.0 experience, you actually saw headline CPI decrease from the time that Trump sent out his initial tweet saying we're going to be launching a tariff war. You saw the CPI decrease from April of 2018 until December of 2019. The Fed brought this up by releasing the FOMC transcripts from the full year 2019, late last year. So the experience that they have to go on suggests that tariffs might be a one-time price shock, but be a greater drag on growth. So that is, on the one hand, what they're considering is their actual past experience. And that goes against the fears that they have that this time the tariffs could be different in their construct, potentially more than transitory in the effect that they have, and cause a sustained rise in inflation. And I think that is why you're seeing this tension in the summary of economic projections versus, you just said, they're taking their GDP estimate down. Right. They're taking their unemployment rate estimate up. So a lot of this is going to play out in the data that we're going to see in the months that come, especially in that second part of the Fed's mandate, that employment mandate, where we're seeing a lot different data begin to manifest.
So if we look back and looking at employment, we look back in sort of that July, August area. I think they only had last year, they only had the June data before they decided to stand pat. And then July and August came in, the unemployment rate was jumping. Everybody was talking about how the Psalm rule was pointing at a recession. Even Claudia Psalm came and said, that's not exactly how it works. It's just data. It points that way, but it's not a rule. And then payrolls dipped below 100,000, I think, for a couple of months. Is that their pain point? Is it payrolls below 100,000? Is it a couple of tenths jump in the unemployment rate? Where's the for our watchers, like, where is the pain point, do you think, for this Fed as it stands now, before they'll say, you know what, we'll take a chance on inflation, but we've got to protect employment?
So I think the pain point is exactly what they've told you it is, which is the 4.4% on the unemployment rate. Again, we were almost at 4.2%, just within a hair of rounding up to 4.2% with the February data, meaning we don't have very far to go to get to that pain point, to get to that threshold where the Fed has to step back and say, we have to pay more attention to the employment mandate vis-a-vis the inflation mandate. So we're not very far away from that as things stand right now. But again, we've got March and April payrolls being reported before the Fed next meets and before that next statement is released on May the 7th.
It seems that if you listen to him closely, and I guess I'm kind of geeky. I watch every press conference and I take some notes too. It seems like he likes 3 months ideally, so he doesn't turn on two. So as you say, that would put us either in May, or potentially if they needed confirmation in June, and barring some kind of disaster on inflation, they could move earlier than certain they think and the market thinks. I had a question. Nobody asked him this question quite directly, but if this Fed were faced with real inflation, because of tariffs or whatever it is. Say it's 3.5%, 4%, 3.5%, let's call it. But unemployment is also jumping to 4.5 plus because of loss of confidence in the markets by consumers and by businesses. Which fire does he fight first? Inflation or unemployment? Or is it, I've got to put out the worst fire first and I'll worry about that one later? Like, where's his priority?
I do think that it is as you describe it. He's going to see where the bigger of the two fires happens to be, right? If you're geeking out with me, then you know that on the front page of the Fed's website that it says that monetary policy must be crafted for the public good. And the public has to be the entire public. So if you're seeing consumers not being able to afford the higher prices that are being reflected in inflation, and that's exactly what the CEO of Walmart has been saying, or Kohl's when they're announcing that they're going to be closing more stores, it's that U.S. households are not able to splurge on discretionary expenditures, that they're only able to cover the essentials, and that even when Dollar Tree recently announced, even Dollar Tree said they're cutting back on essentials as well. So if that is the predominant driving force in the economy, that is a reflection, again, of what we saw in this morning's Conference Board Consumer Confidence Report, collapsing expectations of incomes going forward. Again, you cannot squeeze blood from a rock. That's one of my mantras. And if you cannot pass through higher prices because consumers simply don't have the income to cover it, then as a Federal Reserve, as a central bank, you're going to have to pay more attention to rising unemployment. And again, if he wants 3 months to make for a trend, we saw the unemployment rate go from 4.0% to 4.1, almost 4.2%. If he was to see, again, March payrolls, April payrolls, that would constitute a 3-month trend by the time the Fed meets on May the 7th.
That is absolutely true. Absolutely true. So the market, I think, I don't think there's very much thought, very many market participants thinking about May as a potential move. Now, I think part of what, and you said it just earlier, the tariffs are, you've got to watch Truth Social and have it on notification just to see what the president has said.
Absolutely.
Yesterday he said, I'm going to put another 25% tariff on whoever's buying Venezuelan oil and gas, which would be quite shocking if he does implement that. But could this be the market really getting all the bad news up front, which if it were intentional, all the tariff news and once he gets that done come April 2nd, I know a CEO said, I can't wait for April 2nd, at least we'll get some clarity, probably won't, but he will. Then he gets to cutting taxes and deregulation. And if he gets tariffs where he wants it, or his attention span shifts, then you're starting to get like good news out of perhaps taxes and deregulation. Will that mood really give a 180? Because the move was great in December, and then it turned relatively rapidly. Could it turn rapidly again the other way?
So now you're kind of delving into the purviews of Treasury Secretary Scott Bessent. And how we're going to see these policies play out on the ground. Now you're talking about the 3 weeks that Congress has to take some kind of action before they leave for their Easter break. Now you're talking about actual policy implementation, legislation, reduced tax rates, possibly, cost cutting, possibly. All of this has to be implemented, legislated, passed, signed into law. If we were to start to see some true forward progress and momentum on these fronts from other players, not just what we're seeing on Truth Social every other hour, but from players who are actually going to be pressing forward and implementing these policies, I think then you could see a shift in how corporate America is viewing what's to come in the future.
I guess the consumer confidence is important, and it was interesting that he kind of poo-pooed the University of Michigan inflation expectations surge. But at the end of the day, I guess it's what really corporate America, small businesses, and and bigger business think in terms of hiring. And so far, I mean, for as far as I can sort of remember, the anecdotes have been all bad, whereas the data has been relatively steady, and just the employment is creeping higher. But at the end of the day, it's whether businesses are willing to hire again and see clouds off the horizon. So what's a good good indicator or two to see if what corporate America, the bosses, are thinking?
Well, I think what you're going to have to see is corporate America to come from the beginning to the end of an earnings season without their earnings reports being accompanied by, oh, gee, we're still cutting costs. We've done yet another round of layoffs. We're going to have to stop seeing those headlines. We're going to have to stop seeing headcount reductions, whether it's Amazon or IBM or Microsoft or Google or any of these companies, or for that matter, small businesses, as you say. We're going to have to see an arresting of layoff announcements. We're going to have to see a dissipation in the bankruptcy cycle, which right now is revving up to the highest level since 2009, 2010.
Yeah, and it was interesting. 23andMe, it's not a big company, but it went bankrupt yesterday, or, announced that 2 days ago, whatever it was. And, just those signals make everybody worried.
They do, and they should. And something like a 23andMe is going to garner a lot of headlines. But the fact is that two other companies with upwards of $100 million in liabilities within that same 24-hour time frame also filed Chapter 11. And it's the aggregate of these companies that are filing, whether it's 7 or 11, the 6,000 store closures that have been announced in the first 3 months of 2025. These are the types of things that we have to stop seeing because they're so very visible to U.S. households who, by the way, are on the receiving end of these bankruptcy filings and store closures. There are employees that work at all of these places that are no longer employed. This is what we have to see stop in order for corporate America and households throughout the country to have greater confidence that it's going to be easier to get a job, not harder, that they foresee their incomes rising, not falling, and that therefore companies can anticipate being able to protect their margins without cutting costs further, i.e., pressing forward with yet that next round of layoffs. We're going to have to see a shift in actions taken as opposed to the president saying things are going to get better.
You're absolutely right. And you mentioned before that Dollar Tree is seeing people cutting back on necessities. And you would think Dollar Tree really sort of at the low end of the retailing food chain. You'd almost think they should be counter-cyclical, as people used to think of Walmart as being counter-cyclical. And when they're hurting, it really makes you concern. I suppose there's a possibility that the old journalist mantra, if it bleeds, it leads, and people will click on the bad news, so you keep reporting bad news. Hopefully, it's not just that, and we have a little light at the end of the tunnel. But I think we may be going through a little bit of a dark part of the forest. We have PCE coming up. We have an employment report coming up, so that's be really, really interesting to watch.
There is a lot that's going to be happening in the coming days and weeks. I think that either connects the dots between the very soft survey data, the very soft sentiment data, whether it's CEO confidence or consumer confidence. Either we're going to see a coming together, which would not be a good thing. That would be a rising unemployment rate, or we're going to start to see a shift in the tone out of corporate America that then feeds its way into higher and building consumer confidence. We're not there yet. We won't be there until Walmart stops saying the high-end consumer has traded down to Walmart. And until Dollar Tree stops saying the middle-income consumer has now traded down to Dollar Tree. This cycle has to reverse itself and go in the other direction.
Thank you so much for joining us today. I can't wait until the next chance we have you on board and we can talk about, the next employment reports. And, we are really close in May or June, and that's well before the rest of the market season. Thank you so much once again. It's lovely to have you.
And thank you for having me.